Mortgage Minutes brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. S&P 500 is now up 6.5. I think we're heading the wrong direction. The mortgage-backed securities, do we want to look at that one, being that I didn't bring it up on my screen, and I should have? But we'll look at the 10-year Treasury first. Up 10 basis points, 3.868. And that's a pretty interesting one, as many of these numbers are. We're watching those because of that spread that we talked about yesterday, the spread between the Fed funds rate and the 10-year Treasury. I wonder if I've got the Fed funds rate on my screen here. I guess we don't have Fed funds on this. We have the 10-year Treasury at 3.686. But let's take a look and see that's up 10 basis points. Mortgage-backed securities are rebounding a little bit. They're down 23 basis points. That was an improvement from where we were. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry. Calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. Yesterday, conforming loans locked at 6.316. The Jumbo 6.39, FHA 6.346, USDA loan 6.216. That's for the rural areas and generally no down payment. And the 30-year VA loan, that's the best loan on the market for those that earned it, 6.082. Does not tell us what the rebates or points might have been paid to get these, just tells us what the actual lock was. Why is it all happening? Well, I told you in the last segment, a little bit of it has to do with what the Bank of Japan surprising the markets and doubling the 10-year JGB, the JIB yield cap to 0.5% from 0.25, again, causing their yields to move higher. Big surprise. Markets don't like surprise. The National Association of Home Builders, their housing market index, NAHB Home Builders Survey for December fell another 2 points, 31. The estimate was for a slight rise of 1 point. While present conditions fell, future expectations were higher. Traffic remained at a very low level of 20. NAHB said the silver lining in this HMI report is that it's the smallest drop in the index in the past 6 months. Okay, so we're falling off the cliff. We're just not falling quite as quickly. Okay, it's indicating we are possibly nearing the bottom of the cycle for builder sentiment, said NAHB Chief Economist Robert Dietz. Quote, mortgage rates are down from above 7% in recent weeks to about 6.3% today. And for the first time since April, builders registered an increase in future sales expectations, unquote. Present conditions fell 3 points. Future outlook rose 4 points. Prospective buyer traffic remained at 20. Not good news there. And a lot of that goes right into what I told you from my reporting of the Chapman University forecast, where they basically said that the lack of new houses being built or being started, well, actually, my interpretation, it's going to help the housing prices because there's not a lot of inventory coming online. Housing starts and permits in November were down 0.5% to 1.427 million unit annualized pace. Starts are down 16% year over year. Single-family starts, the most important, down 4% last month at 828,000 unit pace. They're now down, 32% year over year. Housing permits, which is the future supply, were down 11% from last month to 1.342 million unit pace, and are now down 22% year over year. Remember, we need about 1.7 million just to stay flat. Bottom line, there's a big difference between housing, the economic driver, and housing, the investment. Clearly, activity is in a recession. Don't tell that to the administration. But the low supply environment will continue to be supportive of prices and limit the downside risk. Stark contrast to the housing crash where demand was lower and builders were putting up record numbers of homes. CoreLogic single-family rent report. The gains decelerated in October to 8.8% from last year, which was a slower pace of increase from the 10.2. So it's still up 9% roughly. That's not a bad number for an increase right there. Just watching all these different numbers. Still more than double the average rental year-over-year increase pre-COVID of roughly 4%. but this deceleration will help inflation move lower once it catches up in the numbers. We think that'll happen in the first quarter of 2023. We've talked about that before, that those numbers are a big, big lag. So they're generally 6 months behind. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. Call me, 800-306-1990, 800-306-1990.